Okay, well, in the interest of time, we'll go ahead and get started. Thank you, everybody, for joining us today. I hope everybody did have a good Halloween and y'all didn't eat too much candy. This is part of the CWDL webinar series on key mortgage topics for our clients and friends in the industry. Super excited today. We have some of the most brilliant minds in the industry collaborating. We're going to take a look back at 2023, thank God, and look forward into 2024. Join me in welcoming Kevin Peranio from PRMG. He's the Chief Lending Officer. Jim Deitch, co-founder and CEO of Teraverde. Dustin Pfluger, who's partner of mortgage banking at CWDL, and Mark Wilson, who is the founder and managing partner of CWDL as well. Couple of housekeeping items. Please feel free to interact. We love questions. We want this to be beneficial for everybody on. If we don't get to a question, we'll circle back up. And I think with that, we can get started.
Well, thanks, Casey, and thanks, guys, for joining us, like always. Again, yeah, just wanted to kind of get on. We thought it would be a good one to have, a couple, or I guess Kevin is the current lender on the call, but I know Jim and Mark both have experience, running mortgage companies, being involved in banks and stuff like that. So kind of really giving a true, lender perspective of, what's gone on, where are we at in terms of different things, and then kind of just a look into 2024. So I guess with that, I guess we can just kind of get started with just a general kind of, overview, maybe a couple key things that, where we think we're at right now, what we saw in 2023. And then we'll move into kind of just talking about, different production stuff that changed, and then, the cost structure, and then we'll get into 2024. So I guess, jumping into it, Jim, why don't you kick us off and just kind of give us, your just, I don't know, 90,000 foot overview of kind of where we're at, what we're doing right now in the market. So.
Yeah, it's an interesting market in that it's constrained by a couple things, and one of them is inventory. Second is rates. Another is affordability. And aside from that, everything's just fine. But I think the inventory is really one of the things, as I talk to lenders and originators, that is a really tough thing to solve. And that inventory has a couple dimensions. It's the availability of housing, and then it's the cost of housing. So that seems to be, driving the relatively constrained level of production. So that's the thing that as I talk to people is on their mind. A lender yesterday said that his team that were used to doing 9, 10, 11, 12 units of purchase business, super good team. They're doing 2 or 3, and it's simply the inventory isn't there, and they're in the around the Beltway area of Washington, D.C.
Yeah. Yeah. Go ahead, Mark. You're about to say something.
Yeah, I think, to that point, I think obviously most of our clients are independent bankers. The speed in which interest rates have gone up, the margin compression and cost to originate a loan continues to be the storyline for many of them. So it's been a really challenging year, and there are some of our clients that are doing a decent job of finding the purchase business that exists out there, and have worked their model in a way where they could be profitable. But the vast majority are really working hard to get to profitability. So, and I think the future, and I know we're going to get to that point, but it's going to be kind of dictated on the decisions that are made right now and into this quarter and into 2024. So it continues to be a challenge.
Yeah, well, thanks. So we should probably start it off with this. Kevin is on. He's on his phone currently. He's in transit. Had some delays.
I am here with you, brother.
There we go. You are there. I just want to make sure. I just want to announce that to everybody to make sure.
I just don't want to distract anybody with like me driving and my seatbelt, and then people are like, "Oh my gosh, you're on call while you're driving." Just so this isn't my first one to be doing this. If I could just add a couple comments as well on the market. I've never seen so many people so like focused on the 10-year Treasury and the Fed, and obviously the Fed's about to start talking here any minute, and so what are they going to say? Are they going to pause? Are they going to do 25 basis points, one more time this year? When will they be done? Then when will they cut? Everyone's kind of waiting because, we know that if you have rate cuts, obviously there's $3 trillion in eligible refinances that are kind of been brewing here over about a 2-year span. Let's call it by the end of the spring coming up. So, and I can get into the end at the end and leave a message of hope about that. But we're a capacity industry, and that goes for realtors and originators as well. You had too many. And so there's still some deleveraging going on. Unfortunately, our business is certainly rate sensitive. And when the Fed says rates are higher for longer and they're this high, and you're driving people out of affordability, and there's supply constraint, that Jim talked about, it's a problem for everybody. So, we're just handling it one day at a time, one loan at a time. That's all you can do.
Yeah. Well, thanks, Kevin. I don't think, based on your LinkedIn videos, I think you look pretty in character there from your LinkedIn. You're always walking around or in different spots or, in sunglasses. So I think it just fits your normal,
Yeah. Sadly,
personality.
I'm at the Hertz rental car, picking up a car in Dallas and then making an illegal U-turn so I can get the heck out of here. But other than that, yeah, pretty much normal over here.
There it is. So yeah. Okay. Well, let's just kind of jump in, I guess, the beginning. I think probably a good chunk of, the discussion we'll be talking about, I think all this year was all about cost containment, what we're doing there, that kind of thing. But before we get into that, why don't we just talk about the other side of the house? Like the production side, and I guess maybe I don't know, maybe Jim, if you want to kick it off again, just what we've seen on that side of the house that has helped. Or that has worked this year. Are there new products you've seen? Are there different avenues? I guess just give us a little bit of background on that, Jim.
Well, I think the thing, and I'd love to hear Kevin's perspective on this also, but the thing that really seems to be the differentiator between those who are successfully navigating a very, very difficult market and those that are really having great difficulty navigating tends to be a systematic approach to business and a value add in the relationship side to consumers. I was talking to Dave Savage of Trust Engine, and the relationship orientation of how you build to that consumer and help them navigate and understand this is a difficult market. It is an expensive affordability market, but there is hope. There are ways to transcend that. And when you can get into that consultative relationship of helping someone understand that, the end result is less concession, more pull through. And that, I think, is going to be the future of originators that are talking directly with consumers, is how do you really differentiate yourself and do that in a consistent, methodical way. I go back to a discussion on Moneyball and some of the things we've discussed in the past. One of the elements that Billy Bean, the EVP of the Athletics, keeps saying is you've got to have a system. You realize that system requires discipline, practice, and consistent application of that system. And when I look and talk to business owners, particularly IMBs, the success they're having tends to be with people that have a system. It's relationship focused, and they tend to really understand it's going to take 3 or 4 times the effort to get the same number of loans that it did 2 years ago. And in some cases, it's going to take 3 or 4 times the effort to get half the volume or a quarter of the volume. But getting that available revenue is going to the people that really have that relationship focus.
So Kevin, what are your thoughts on that? What have y'all done different this year on the production side or on the origination side? To kind of distinguish y'allself, what are y'all doing? I guess, and you don't have to give away big secrets, just high level.
Yeah, for sure. Well, to Jim's point, I mean, the consultative approach is, how do you provide value? What is it that you do to help the consumer? I saw Phil Treadwell speak, and he said, look, either you're solving a problem for a consumer, or you're not able to communicate your ability to solve that problem, or you can't solve that problem. And I thought it was pretty interesting. I mean, the value is solving problems. And, so one, I'll just give kind of one nugget I've been sharing. Non-QM is a great way to be a better originator these days. I mean, when have we ever been able to say in a while where, hey, there's this whole new line of products out there? Learn them. Learn this whole new set of products that literally never existed in our history, and go, solve more problems for consumers. So I'm not just talking about bank statement loan programs. I'm talking about, all right, this guy's got some challenges on credit. This person is an investor. This person is, trying to find a way for the home to cash flow. Did you know this brand new guideline that came out from HUD that allows rental income on an ADU? Just knowing your guidelines and knowing new products is a way to differentiate yourself. And we're back to old school selling. I mean, there's a lot less originators out there. Another great stat I saw from Phil, he came and spoke at our retail channel leadership conference. A couple of years ago, there was 188,000 loan officers that fund one loan every 90 days. Now we're down to like 82,000. So, that's not the total mortgage loan originator headcount, but there's just a lot less people out there, because the ones that were doing one every 90 days, they're getting washed out. So you got to find a way to, be consultative, to Jim's point. We have to find a way to solve problems. And there are, believe it or not, new ways to do it. Just in one other example, I just got off our cap markets call. We do it the first Wednesday of every month. Gary Malice is my partner in the company. There's the two founders, Paul and Robert. And Gary Malice runs this cap markets call. It's a really good call. We are releasing tomorrow a standalone second lien. So all these borrowers, if 80% of the existing home universe has as a first lien, 5% or less, if they want cash, they're taking a second lien out. So we're doing standalone seconds, not a HELOC. And we offer bank statement income qualification as, if needed. Obviously, pay a little higher rate potentially by not going full documentation. But again, we're having to reinvent ourselves. We're rolling out new products and then teaching our people how to sell them, and then, show their value and be consultative in their approach.
Got it. Thanks. Mark, so any thoughts on that, or anything you've seen within our client base that you've seen, been working?
Yeah, I mean, to this point about non-QM, we're seeing non-QM lenders, obviously more and more of that product coming through. I think to the point of, loan officers were drinking through a fire hose in 2020 and 2021, learning how to sell again and working harder. I mean, there's a shift, right? That's hard for a lot of people to do and create those key relationships. But this business has been the same for a long time, especially from the retail perspective, having a relationship with the right realtors to get the business in and create those relationships. Those are the people that are still doing loans and are finding a way to provide the products that they need, even through DPA and some other things that are out there. So, but the affordability challenge and the amount of inventory that exists, all that still remains. But that being said, there's still a ton of loans being done. And so the originators who are paying attention to where the opportunities are and really working to get that and earn that business are the ones that are going to win, right? And those are the ones that we've seen this year do well. So
I think, just going back to one of the things that Kevin raised, that I think is really an excellent point, is, Dodd-Frank homogenized the product for so long. We got into, it's all 30-year fixed rate. This is it. And with the proliferation of the non-QM, both first and second lien, some of the differentiation in product for those that are with depositories, the ability to do the the portfolio, although it is not priced like it used to be, it still can do things that potentially the secondary market hasn't yet been able to fully absorb. But I've been watching the private label issuance of second lien loans, and it is exploding. If you're not in that game, you are missing, I think, a huge opportunity to build a relationship with someone that needs liquidity out of the equity they currently have. And to Kevin's thought about, when rates finally do break, there are a relatively large number of loans that ultimately become refinanceable. If you have that relationship and have a reason to be with that person, if you've helped them with the second lien or helped them through this product and keep in touch and keep on working that relationship, those refis come to you when they come.
Perfect. Got it.
Yeah, the only thing I'd also add to on the production side that we're seeing from clients that are growing are they're through consolidation. Obviously, there are, there are fewer originators out there, and as a result, there are loan officers looking for homes to join or join companies where they can originate. And we're always cautious on that to make sure that you're bringing in the right originators onto your platform who are actually doing loans and not doing one loan every quarter, to Kevin's point, but bring on the right originators that do good business. There's still plenty of opportunity for that as well.
Yeah. So with that, I guess that segues into the next piece. I mean, with just M&A, branch acquisitions, whatever the how it's structured. I mean, I guess Jim, what have you seen, so far? I mean, what have you seen this year? I mean, I know there's a lot of consolidation, there's a lot of acquisitions. Like, I mean, are you seeing just these big companies, merging just a bunch of smaller companies as branches? Have you seen any true type, mergings of equals? What are you seeing out there that's going on?
The deals that are getting done are ones where at the end of the day, you have a successful acquirer that is bringing in business that is accretive. The deals that do not get done are two companies in trouble thinking one piece of trouble plus another piece of trouble equals success. It does not. And fundamentally, the time that we're pretty active in the M&A business along with many of our peers, the deals that get done have a structural element that it's good for both parties, and they're bringing something to the table that otherwise would not get done. We've advised on a number of acquisitions of IMBs by banks, and the ability to get that done is that the mortgage banker has a client and a marketing and a production team that is inherently better than the bank. And the bank has a better counterparty view. They have some loans that, to Kevin's point, are differentiating way over what used to exist. So it's construction to perm, it's swing, it's standalone seconds, it's piggybacks, it's portfolio, and it's access to the bank's builder business. It's a way to go through and say we've got competency on the origination with competency in the cost side and the product side. And those deals make sense. We've seen a lot of deals that just don't happen. They get close, but in the end of the day, there's just not enough there. I mean, Mark, you were talking about people liquidating their servicing portfolios and just trying to get down. When you're in desperate straits, it's really hard to do a deal when you're in desperate straits. So, Mark, I'll throw that one to you because you're close to this too.
Yeah, I mean that's a factor, right? You watch who's selling off servicing, and in this market that it's an interesting dilemma, right? Surprisingly enough, we have one deal that is pretty good going on right now through a PE firm, which I think is interesting. But the company that they're going after, and it has not closed, to your point, we hopefully will see it close, is that company's grown and shown profitability. The fundamentals of the business are still good. And that particular company is being looked at as kind of the volag for the rest of the deal and the rest of the market. And hopefully we'll see that deal get done. And I think it can be, but that's the exception. I think most of the M&A deals that we are seeing aren't true M&A. They're, take your balance sheet and shelf the company and come fight another day and put your originations here, and we'll give you, a branch override, and you become a branch of a bigger bank that might be better capitalized to deal with this market. The alternative in some of those transactions are the company allows their net worth and liquidity to go down to zero or negative, and they're out of business anyway. So what's the point of that? And they're companies we preach, cut as deep as you can, as fast as you can, to make sure you get to a set of profitability. But we do get pushback on that sometimes, saying, you can't cut into the bone, there's nothing left, we can't remain a bank. And that's when the decision tree changes. And when do you start to look at that? And that's probably too late for an M&A deal where ownership is getting anything exciting at that point in time. That's more of a, let's survive to 25, as you said, as a terrible message before, into the next, into the next time period. And so we hope people make decisions before they get to that point. But
Mark,
that's
it. Yeah, I was gonna say that's a very interesting kind of way to think. I guess thinking of it from an M&A standpoint. But if you were acquiring another company and they had not cut, would you? You're acquiring bloat, right? So
no, I agree with you. I'm just saying not to the point where it's too late, where you have negative equity and you got, no more liquidity. It's the point of the timing of that, for sure.
Oh yeah. And the liquidity
everybody should be cutting. Yes, that needs a cut for sure.
Well, it's when you say liquidity, I don't know if we make these points enough to the people that are in our business and all the different lines of work. We buy and sell money. That's what we do. We buy and sell money. That's it. And that money is a mortgage-backed security for us. It's real property, and a borrower hopefully making their payments, and that's what collateralizes the fixed income mortgage-backed security. And right now, the biggest buyer of mortgage-backed securities, the Fed, is selling. And by the way, the Fed announced no rate hike, so they kept rates steady again, second time in a row. So we'll see if there's any nuggets in the press conference. It'll be put up for.
Go ahead. I said we heard it here first. No, keep going.
Yeah. I'm sorry. I 15 minutes late. I could have told you earlier, but there's less liquidity in our system. There's less money everywhere, and so it is a squeeze. And this M&A activity, it's very sad. But we build up these teams and these bonds and these cultures and everything's awesome. But if you don't have servicing, or if you don't have, what do you have that's worth anything, right? So it's hard to just buy assets, and which is just it's a team of people. What do you have? Look at Finance America and Loan Depot. Their CEOs are out there saying, well, we've got proprietary tech, we've got special services, and we're different. But at the end of the day, Wall Street does not like our business. Rates go up, business goes down, we're not worth a damn. So other than your cash and your servicing portfolio that continues to spit off, money. And so, yeah, our business, the secondary market, is something I like to say all the time, is cold, heartless, and unforgiving. And, we're in a very unforgiving time. Having said that, to your point, Mark, I say it literally verbatim. There's a ton of business getting done out there. There's a lot of business getting done out there. It may not feel like it because we've had such a huge sugar rush, and high in 2020 and 2021, but there's still a tremendous amount of business getting done. And so while this liquidity draws out of the system, and there's a lot of deleveraging, and there's a lot of loan officers and realtors and, lenders that are, exiting, when things turn back around, it's going to feel a lot busier than it did, I would say, arguably even in 2021, because 2021, we ramped up as much as we could the second half of 20 to handle, the volume. But 2021 is pretty steady as she goes. But now we're everyone's about 50% down, maybe even some companies 60% down headcount wise from 2021. And I honestly don't think it'll take much for this industry's business to double. I mean, if the Fed decides, to start cutting rates and putting liquidity back in the system, next year, I don't like that survive till 25. I know it rhymes, it's cute and all,
Yeah,
but that's a commercial real estate theme.
Yeah.
And that little jingo came out of the commercial real estate which is a real problem because they still have leases to exit. We are the first industry usually to rush into the boom and the bust. And so, we've been in a full-blown bust in housing for about a year and a half. And I mean, like full-blown recession. So I think our time is coming next year. And I'm not trying to be Pollyanna here, but if the Fed is done raising maybe just one more time, then they know something, right? Things are going to slow down. Think something's going to break. What's that going to be? We know commercial is going to be breaking a lot next year. But I think if this demand structure for consumers keeps going the way it's going, something will break somewhere, and the Fed will be forced to cut, and that's when we'll see. Again, I arguably it'll feel like one of the best years we've ever had, if it's not actually the third best volume number. And it won't line up with the calendar exactly, right? It could happen. The first cut could happen in July, and then from 12 months from there, mid-year 25, we're on a run, and it'll be epic. But yeah, like you said, we're surviving until the cut. How about that? I don't know if that rhymes or not, but
yeah, I think Jim and I were talking about that survive the 25. We both hate that also. but yeah, that's
So Kevin, let me give you a different view, and this is not my view, but I just want to articulate it because I think it's worthwhile for us to think about. You mentioned the Fed's quantitative easing is done. They're not buying the 80 or 90 billion dollars of fixed rate loans or fixed rate bonds that they were buying previously, and the banks who loaded up on the Treasury and mortgage-backed securities, their mark to market on their equity is last thing I saw from Sandler was around $650 billion negative. So and the Chinese aren't likely to buy any fixed rate bonds soon. So what if the Fed cuts, but the long end doesn't drop because there's no demand from the traditional buyers that are doing that? How do you then look at the continuation of the business? Is it arms? Is it we just people eventually learn that they're going to be able to just deal with a 7 handle on a rate or a high 6 handle? What I'd love to hear your thoughts about what if the Fed reduces rates and the long end doesn't commensurately fall, because I do have some concern.
Yeah, the good thing for mortgages specifically is we follow the 10-year. So our mortgage rates, because an average mortgage kind of lasts about that long, that's really the gauge. So the 20-year and the 30-year long bonds aren't the best, side by side to compare for a mortgage interest rate, even though it's on a quote 30-year mortgage. So we're watching the 10-year, and that's the big one. And now, so to your point, there's a couple of things. That's obviously a shorter term, 10 versus 20 or 10 versus 30. So if the shorter terms, you start to see yields go down and bond prices go up, that's because, the institutional investors are sniffing out slower growth, even potential recession. And, we're all looking at the same data, right? So that is going to be a shorter term play. Now, long term, since you brought up the 30-year bond, I have this kind of dumb, wonky theory. I don't think it's conspiracy, though. I think our country, I think our leadership, and I think this is a very long-standing policy, and nobody wants to step out and change this policy. Just like, it's going to take someone very disruptive to do it. Just like we don't, no one really wants to step out and take austerity measures and take care of our cut our welfare benefits to balance the budget. We've never dug and really drilled. I know it was cute to say drill, baby, drill, but we never really did it. I mean, we have enough oil and energy to be completely independent forever. Maybe not forever, right? But certainly in our lifetimes, right? So the question is, when do you break that seal? When do you break that seal for oil? And when do you break that seal for the 30-year bond? You know, our Fed, in all this selling of our, you know, our overspending as a government, they did not refund our treasury and all of our liquidity in a longer duration. And they purposely chose to put our economy through more short-term pain by selling a lot of shorter duration bonds and treasuries instead of that 30-year yield curve. Instead of selling the 30-year long bond, we didn't want to mortgage our debt as a nation, to be quite honest here, to have a 30-year, you know, debt, you know, of our entire, you know, 5% of our GDP, our 5% of our GDP is our current deficit now. And we just made a conscious decision as a country not to go that route. And I don't know if we just don't want to break that seal, if we don't want to say, hey, you know what, we're really a debtor nation. I'm going to need a 30-year. My payment is too much for the 10-year. I'm going to need a 30-year mortgage for my debt. We haven't broken that seal either. Now, I have obviously seen the 30-year long bond yields go up a little bit recently because there's been a little bit of a buyer strike, to your point, Jim, about who's buying our debt. The Fed is the #1 buyer. They're not buying. They bought $2.5 trillion in 21, $1 trillion in 22. Now they're net seller, right now. China and Japan are two biggest next buyers that are foreign buyers. They're kind of dealing with their own currency. And to your point about market to market, they're having to sell U.S. Treasuries at a shitty price, by the way, because they need the cash to keep their economy and their currency afloat. And so, you know, not to get too esoteric and get out of bounds here, but our mortgage rates really follow the 10-year Treasury. And the Fed has said it over and over again. We will put our country through a recession. We will put our country through a job loss recession. We will crush jobs if that's what it takes to get inflation under control. And that has also been a reason why they've kept our debt funded and mortgaged under 10-year treasuries and under, and not, you know, 7s and 5 years, not really going down the 30-year yield curve. Not yet. We haven't broken that seal, just like we haven't really drilled for true energy independence here at home either. It's like we're just holding these cards in our vest, right? I mean, it sucks for us right now. You know, maybe they do it when we're dead, and maybe it'll benefit our kids, but I'm not seeing it right now.
So, you know, Kevin, I think you make an excellent point on the energy aspect. And the other point I'd make, and this is counter to those that say that rates won't come down, the spread on the 10 years to the consumer mortgage rate on the 30-year, because the durations are roughly the same, as you point out. You know, we're at the 310 basis point spread over treasuries. Historically, we've been at 150. So there's a risk premium of 150 basis points, and you have to ask yourself, why is it there? And one will say it's the credit risk in mortgages, and I don't believe that. The piece I do think is if people are going to invest in mortgages, they're going to want to get some prepayment protection by getting that much higher spread up front. Once the Fed signals that it's done and the economy does the traditional contraction, then I think those spreads contract. And even though there aren't that many buyers of fixed rate instruments, when the spreads contract from 300 to 200 to 175 to 150, that's a direct reduction in mortgage rates of 150 basis points. I don't know about you, but that would, I think, change consumer confidence. It would change the thought process with respect to affordability. And I think it would just change the directional aspect. I mean, I talk to people and they think, well, rates are going to be going to 12. Not possible. There's no way this economy could tolerate that. There is no way. It's just not going to happen. So let's get that out of your mind. It's not going to happen.
You bring up, you know, maybe think of two really good points here. I love the whole, that 150 spread. Like, so the current mortgage 30-year interest rate versus the treasury, right? That spread is, like you said, let's say traditionally 150. I've heard it at 170, but either way, if what the secondary market is saying is two things. They're also add another 50 basis points to that. because 80% of all existing mortgages have under 5%. And the secondary market is like, hey, they're locked in. So add another 50 basis points, right? So even if the spread is, it's 100 basis points or, 80 basis points, whatever it is, the reason why there's that extra spread is because it's been a year since rates started to come down and then went back up, which means we're a year closer to whenever the Fed is going to cut. So people who buy these mortgage-backed securities, they know every single new loan you do today is going to get paid off like next year. So they like, if I'm going to only have this thing on my books for 6 months to a year, then I need more premium. And that's exactly what margin compression is. And so if people want to know what margin compression is, and one more point, the 10-2 yield curve inversion, you hear that a lot. So like, naturally, you would think a shorter duration, a 2-year treasury, a note like that, you would think, okay, what's going to have a lot less yield because it's very quick, right? But if you give me money, for 10 years, I can give you a little more yield because you're betting like this is money I can count on a little bit longer. But the 2-year yield has been higher by as much as 100 basis points for the last couple of years. And that's basically saying we don't believe in the short-term economy because we're going to go into a recession. So we want more for our money in the next 2 years because when this thing comes due, I can't put it in a stock because we'll be in a crappy economy. And so what we've noticed is that 2-year spread above the 10-year has been as much as 100 basis points. It's gotten down to about 17 basis points. And so I've been in the last, like probably, let's call it 1 month, I've been talking a lot on my LinkedIn videos about watching that 2-year yield. That has always fallen first and come back below the 10-year yield when we are in that, like, all right, we're really close to a very slow economy, a slowing economy. Remember, anything under 2% GDP is considered under trend growth. Negative GDP quarters are considered recessionary. All of those, all kinds of new ways to define it. But watching that 2-year treasury yield come down recently, it's only 17 bips above the 10. And that thing will continue to fall as we go into 2024. And that is a big telltale sign of when the Fed's going to cut, when the weakening is happening. And so, it's a flight to safety on the short term. So, some really good points you bring up. And I know it, like, it's, if I'm a realtor, I'm a originator, I'm listening, I'm like, so what, but it's good to know macro trends, and so, these things matter when you're trying to talk to borrowers who are all waiting for rates to come down. They're all waiting for prices to come down. Got news for you. Prices aren't coming down. They didn't come down last year. Last year was your last good chance to get a good price. They came down a little bit in the second half, and then they went up. And today, right now, between now and March, is your second to last best good chance to lock in a good deal on the price because they are not going down. They are not going down. There's no housing supply. Next year, when rates come down, everyone's going to come into the market wanting to buy, and there's not new houses. So, we just, these are things that help you kind of talk to consumers and think about how to strategize and where and when to go. But it is fun waxing on 2-year, 10 years and yields and treasuries and long bonds. But, we got to bring it back into the parlance of how we talk to our consumers every day, too.
Yeah, which is buy the house, rent the mortgage.
That's right. You can always renegotiate rate later. You can't renegotiate the price, right? You get one shot when you buy that house. So now's a good time. It was better a year ago when I was screaming from the rooftops. And you look at all the the FHFA, the Case-Shiller, all the price indexes, they all went up again. They went up again in this insane year. You talk about normalizing high 7% rates. Now we normalize it, we got appreciation in that market. And so, so when rates come down, more people want to buy houses. Something like 5 million people are priced out of affordability when rates went from 7 to 8%. Since 2021, 28 million people cannot afford a house. That's 28 million people potentially sitting on the sidelines. When rates come down, there's your higher demand. And then here we go. We're off to the races on home prices again.
Well, thanks guys on that. That was a long point in discussion there that we were talking there. Let's jump in so we can talk. We have a question about some costs, so I think that's a good time to break into this kind of cost discussion and stuff like that. I think in the last quarter, there's probably, if there was any good news, it's the news that cost of origination has come down probably about what $2,000 or something like that is what the MBA said from Q1 to Q2. Bad news is still operating at a what $500-600 loss per loan. So I guess just jumping into that. I mean, it doesn't sound like we're done with cuts. I mean, what are y'all's thoughts? I mean, are we done with cost cuts? Are we still needing to focus on cost cuts? What do you either one of y'all go here? And where are we at? Which is just right sizing the ship, I guess.
My quick answer on that is no. I mean, there was a report that it came out that origination volumes are like over 50% down, yet the labor costs are only about 25% down. So simple math tells you that that's not enough. I think many clients have not cut deep enough. That being said, compliance has gone up, and so they're CFPB keeps trying to pass new rules and new regulations. I think the NBA just put out a white paper recently that they want to jump in and regulate even more on the independent side for non-bank lenders. So it continues to be a challenge. A cost to originate has to come down. I mean, it still has to come down. That if this was any other industry, they would find a way to figure that out. I think many of our lenders, like I've said this before, and I've said in other webinars, so I'll try not to repeat it exactly. But if you're manufacturing any product, and the more products you made, the more money you lost, you'd find a way to make the product for less or go do something different. And so that continues to be a challenge. And something we talk about. And I think a lot is people keep waiting for the next turn. They keep thinking there's one more branch they're going to bring on, and that's going to change the outlook of how they can be profitable. But until you make your model correct, when that one loan that you do originate, you can be profitable on it, and then repeat that over and over, it's still a challenge. So there's still a lot of costs that need to be made, in my opinion. And we're seeing that. And we're not seeing a lot of positive P&Ls come out.
I will just add that, we're a very positive, hopeful, enthusiastic bunch, all of us on the independent mortgage banker side. And, the spring purchase season was pretty good. We were decently busy. I mean, our biggest month we ever had as a company was 1.75 billion funded in a month. And we did just about 1.1 billion in the spring in 1 month, and just under $1 billion the very next month. So let's call it, April and May, we average about $1 billion each. That's, with managing overtime and, doing 32-hour work weeks and all the stuff that we've been doing, we've been trying to hang on to our people as long as we could. But I think, there was definitely a change in mentality amongst, I think, C-level executives at the last Fed meeting when they came out and said higher for longer. And then the 10-year treasury just shot up like a rocket. That was it. I mean, you can't be hopeful. And so, unfortunately, I think a lot of lenders are having to do more cuts right now. And it's awful because if people have been fiscally responsible, they've cut out the unnecessary people in the past, like people they can get by without. The cuts nowadays, you say to the bone, they definitely hurt, right? They're people that you absolutely had no intention of letting go, but you've got to do it. I mean, you can't fund 50% less and, and not come out and, I mean, look, just simple math says you do 50%, right? And we're not at that level at PRMG by any means. We've had some natural attrition on the originator side. But it's a tough time of the year between now and February anyway. Everyone knows it. We're in a normal market where it's seasonally slow, but then with rates where they're at, it's a tough time. So I definitely see this fourth quarter being probably my guess is the last round of cuts for most companies. And I would say probably the most painful one because people that you absolutely had no intention. I mean, you know, if it was just money and we were heartless in July of 22, when we saw the market going down, we could have just whacked 50% of our staff, and it would have hurt. But think of the millions of dollars I mean, literally millions and millions of dollars we would have saved in the last year or more. But most C-levels are like, we're going to hang on. We're going to hang on. It's going to turn. The corner's going to turn. It's going to get better. And then it hasn't. And I tell people the difference between this market in 08 and 07, which I experienced as well. I've been in the business only since 01. But, you know, it was a light switch. Like, it was a credit crisis, and you just were out of business overnight, right? And so the switch was flipped for us because of all, you know, the programs and the, you know, mortgage-backed securities that were put together by all the, you know, the Wall Streeters that think they're smarter than all of us dumb salespeople. Well, you know, they put a bunch of programs out there that, you know, what do you know? When you inflate and allow for fake income and assets, and there are no systems in place to control for quality, and you say that appreciation will last forever, well, guess what? That implosion just melted our entire industry down overnight. This market is a slow burn. It is a very slow burn, and it has been a grind. And, you know, and so, you know, when you're in that kind of market, kind of one of the jobs I try and do is give people some hope and some light at the end of the tunnel. And I'm not saying that hope is a strategy, but I don't want people negative on my team. You know, I want people to be hopeful, because we know it will turn around. When my best guess is, you know, we're going to have a decent spring purchase season coming up, especially with all the capacity taken out. And I really, truly believe the Fed's going to cut sometime next year. Their first cut, I don't think, will be later than July, because, you know, we have such high rates. There's such low demand on so many things. I mean, we'll have at least a year's worth of lagging data that should be enough for the Fed to see where we are. I mean, our real rates today, you know, are insane. You know, inflation has come down. They just don't want to risk letting the genie out of the bottle again. And so the only thing they can do is just do quantitative tightening and raise rates and keep them there for as long as they can and hold on. But I do think we'll have a decent spring purchase season, which really doesn't materialize for us until fundings and revenue until March. And then after that, I think the Fed will cut. My guess is no later than July. That's just me going on the record, one man just saying his opinion.
Like it.
We're gonna post that later today, Kevin, on LinkedIn, that this is what we heard from Kevin. And, you know, this is what's gonna happen. So, Jim, I know this is like one of your probably favorite topics and where y'all are most involved. So, I mean, what are your thoughts just on, you know, cuts, employee cuts, how people are cutting, you know, all of that, I guess.
Yeah, I think Kevin makes a good point that there are lenders that have had some pretty, you know, they're pretty proactive at normalizing their cost base given declining revenue. But as I think about my friends and colleagues and clients in the industry, there are a lot that really haven't gotten to the point that unit-wise, we're 65% of what we're doing at the end of 21, 65%. So 65% less units, maybe 50% less volume because of housing appreciation. But 65% less units, you would expect the industry, if it were tracking and trying to keep its costs, to be at least at 65% down. And the reason is that you have some people that are incredibly productive, and that top tier of people are really those people that generate a large amount of the volume and a large amount of the profit. And then you have another tier. If you go into this 1/3, 1/3, 1/3 view, you've got a bottom tier. And that bottom tier is really consuming up a lot of the resources that the top and middle tier take. And then that middle tier goes into two areas, the upper end of the middle and the bottom end of the middle. So you would expect that lenders would have removed the bottom tier and about half of that middle tier to get to 50%. The fact of the matter is, when you look at the data, they haven't. The variation in productivity, whether it's on the production side, the underwriting side, the processing side, any of the roles that we look at, the difference between the top performers and the bottom performers and the middle performers is really huge. I just talked to a good friend of mine with underwriters, and and you look at the average underwriter doing 15 cases a month. And my question is, how long can you carry an underwriting cost at 3 times normal? Because you'd expect a good underwriter to do 40, 45 cases, not 15. And it's been that this individual's been carrying that 15 kind of underwriting caseload for the last year and a half. It is costing them a fortune. And I just don't think it's sustainable. So when I think about rationalizing the workforce, it's not just the numbers, it's not just cutting dollars or people, it's separating who is really highly productive and who is not highly productive. And I don't think the industry's done a good job at really differentiating that. Mark, I'd love your thoughts.
No, I agree with that. Jim and his team, top tier and they line up, everybody in your company, and they can tell you these answers. And so one of the questions we had was, what's the formula for reducing the $13,000 a month cost to produce a loan? And I think that's a great segue into this topic. If you look at that number, let's talk about what goes into that. That's loan officer comp. That's all the direct costs to originate the loan, all the lost opportunity fees that you've paid for that loan that never got funded. So how do you drive that down? There's a few things. You look at what's flexible and what's not in that particular scenario. If you look at lost opportunity, like loans that you started but you never funded, like what are you doing to try to minimize that? Is there a relook, a second look, a third string? Maybe there's another product type that you can repurpose that loan to. Maybe that goes into a loss pile and you have a lower commission loan officer that works lost deals to try to get those back. Because if you have a good loan officer, hopefully they're not putting a deal that they haven't pre-qualified into the system, because if you do, that slows down your process, which speaks to the quality of your loan officers up front. If your loan officer is throwing anything that hits the wall into your machine, your cost to produce that loan is going to go up. And so the tail end, your lowest performing loan officers, which probably make up a big percentage, the 80-20 rule, probably 80% of your carry makes up, 80% of your cost, and only 20% of your people are producing the most revenue. If you focused on those 20, that cost to produce would drastically go down. So that's what goes into that, and looking at that, and there's a way to do it. And when I talk about a profit first perspective too, in this industry, you have a 45-day window that tells you a pretty good story. And I think if you look at your locked pipeline, you could predict out where you're going to end up pretty good on 45 days. You might not be able to see where you're going to be at in 120 days, but at a 45-day window, you can see how much money you're going to be having coming in on a rolling 45 days, just all the time. And you can take that number and multiply it times 10% and say, I want to make 10% profit. And that creates kind of what I'd call an expense gap, an expense target number of the live-in. In professional sports, we call that a salary cap. But here you can create that number and you can start managing to that. And I think the companies who do that really well have found a way to be profitable even in this tough market. And so that's how I'd answer that question. And welcome any thoughts from you all on that. But and I don't know, whoever asked that question, it didn't have the name. If you want any further clarity, feel free to reach out or ask another question. But that's what goes into that.
Yeah.
I was going to say loan officer comp. One other thing. It's a really tough thing. I know for most originators, loan officers are your customer, really, right? Those are your customer that you have to keep happy. And I understand that. But the loan officers who aren't good partners with the company, the ones that are always coming in for concessions and always pushing things down, I think those need to be evaluated and looked at. Some of them might be your best customer. Some of them who come for that might be, but some of them might not be, So just having a real transparent, open dialogue, explaining why, giving up 25 basis points or 50 basis points every time they go to do a loan just hurts the bottom line of the company, and the company can't survive, and that doesn't work. So really having honest and open conversations to that point, depending upon what your model is, also helps.
I agree. I think the originator comp is, it's such a touchy subject. Our company, we say built by originators for originators. We literally, that, like you said, that's our client. But I think there's a way for that to still be the case, but then have conversations with branch managers who, get paid on a P&L to say, you've got these part-time LOs. I mean, they don't even, make up for, the insurance costs that you're drawing. This is kind of thought like, well, I got this guy on my team. If he does a loan every 90 days, we're good. That's not, that, I mean, I understand that logic. And I mean, you have to make sure they don't call, they don't talk, they don't do anything. They don't are they literally not doing anything except when that one loan comes up, and then they are, or are they doing all this crap in the meantime that they are unable to, pull through, and it uses your resources. You have to be very judicious about that. But great points, Mark. It's that time of the market. No stone unturned, no sacred cows.
Yeah, it's funny that to your example, that loan officer does the deal every 90 days. If they're making a car, they'd put all the pieces to make that car, but they'll forget the wheels and the steering wheel. And what does that do to your production line? I mean, it stops it, and then so your costs produce out. That means means your underwriters are now doing pre-quals, and is that the best use of their time? So anyway, sorry, but.
Yeah, and here's the empirical number that 50% of your people do 20% of the activity, whether it's revenue or operational efficiency. So that Pareto rule, 50% of your people do 20% of the value add, 20% of your people do 50 or 60% of the value add, and that's why it's $12,000. If you look at that bottom 50% that are doing 20% of the economic activity, and you look at that very, very right side of that tail, you will find a huge opportunity for productivity. And to your point, Mark, a huge opportunity to reduce the friction in the system, because the junk that ends up coming in from those low producers just trying to get it done, as Kevin said, just clogs things up. So that's my last word.
So one thing was we said we'd talk a little bit about 2024. I want to close on somewhat of a positive note. Everybody give us one thought on an opportunity going into 2024 and what you see the opportunity for next year. So
Yeah, what, 2 minutes? You have 1 minute or 2 minutes,
yeah,
right?
rapid fire, just go.
Rapid fire, go. Okay. You go first, other people, I'll go last.
Kevin, go. Kevin, why don't you run with it first?
All right. So the average time from the last rate hike to the first rate cut in history is 4 months. 4 months. So if they're done, or maybe December they're done, 4 months from there. Maybe there's so much cash in the system, it'll take a little longer than 4 months. When that first rate cut happens, there's about a 200 basis point drop, in pricing out of mortgage-backed securities, and not necessarily note rate. And we've been stacking up, 7 and 8% first-time home buyers for, it will be about 2 years come June. And so that's about $3 trillion with the largest loan amounts ever. I mean, it doesn't take much for there to be a net tangible benefit. There's been a lot of refis coming real soon.
Perfect.
Not 25, 24.
20. There we go.
Yeah, and spreads tighten, which actually supports Kevin's theory. Mark?
I would say there's lots of opportunity. Deals are being done. There's still a ton of business being done. There's winners and losers in all markets. So just find out the way you all can win. And I think being part of these calls and paying attention show that you could all be the ones that are that way. So.
Well, and there's lots, I mean, to elaborate, I mean, there's lots of talent out there too. I mean, I think that's something, when stuff turns, there's going to be, there's talent out there. So.
Yeah.
Okay. Well, with that, thank you all. Casey's going to end us here, but thank you all for participating. And Casey, why don't you wrap us up?
Yeah, Jim, Kevin, thank you guys so much. You so insightful, and I bet you guys we could probably all wrap it out till about 5 o'clock tonight. But appreciate you so much. Recording will go out after this, and a little survey will pop up if you guys would be so kind. Go ahead and take the survey so we can continue bringing you relevant topics. Other than that, take care, everybody. Thank you so much.
Cheers. Take care. Hey, great to see you
Thanks,
guys.
y'all.
Thanks.
Cheers.
Bye.
Thanks, John.
Bye-bye.
Thanks.